Hello, I'm James Woodburn. Welcome to the first proper Friday Insider of the year, at least with me anyway. I'm joined today with Murray Dawes. Murray, welcome, mate. Happy New Year.
Happy New Year, Woody. Good to be here, mate.
Yeah, and so this is, I want to do a lot more of these conversations with all of our editors in this part of the Insider. We're going to be talking a lot more about the markets, what we can expect in 2021. So, Murray, I've been looking at your track record, and I did a little review in my last update of the year in 2020, and I think I might have even overlooked your one. You've got hardly any losses on the table. So I wanted to pick your brains a little bit.
Yeah.
A lot's happened over the Christmas break. The Democrats. Let's start with the US because really the global markets stem from there, right?
Yeah.
There's now no question Biden's going to be in. We kind of knew that anyway. But the Democrats have taken over all parts of the government over there, haven't they?
Yeah.
So let's start with the bigger picture and what that really means for the markets in 2021, in your view.
Yeah, look, I think it's been really interesting what's happened since the confirmation of them taking both houses of Congress has come through. I mean, there's been some big moves in the market. Sometimes it's been accelerating a move that's already happening, but I think there is a lot of positioning going on in expectation that Biden's going to come in and be willing to spend and print as much money as necessary to reinflate. And I think we all sort of know this, and maybe people were partly positioned for it, but I think it's been a bit of a surprise for the market. And I think for me, the most important thing to look at is those long bonds in the US, because that's the fulcrum for the whole market, right? That everything is priced off that. If you've got the long bond in the US at 1%, all of the equities like the tech stocks, all that sort of thing, their long-term cash flows are being priced off very low long-term interest rates. So when you do an NPV calculation on a company, you're bringing back those future cash flows at a certain rate and saying, okay, those future cash flows are now worth this much money. When rates are near zero for 10 years, those future cash flows, the value of those cash flows goes up a lot. So you've seen this massive rally in these tech stocks, which isn't just on their growing, expectation they'll make more money. It's on the shift in those long-term yields in the US, which is making the value of those stocks go way up based on expectations they'll be earning a lot of money in 10 years' time, for example. So as that long bond, as that rate goes up, if it really does go up a lot, you're going to see some cracks appearing in especially those tech stocks, and that will end up hurting equities. So the thing I've noticed is that the US long bond really did sell off quite sharply as soon as the news came out that they'd taken both houses of Congress. And look, I'll just show you quickly the chart just so we all can see exactly what's going on. So you can see that?
Talk us through it.
Yeah, you can see the chart?
Yep, can see it.
Okay, just bringing up this so that I can easily show you. So you can see that since the crash, so we had the crash last year, and the rates fell from like 1.8%, and this is the 10-year bond yield. And the rates crashed to, nearly 0.3 of 1%, and that's for a 10-year bond. So you're getting 0.3 of 1% for 10 years return. Now, since then, you had rates initially really spiked, and then the Fed stepped in and held rates down. So rates crashed again. But then in August last year, you can see they based, and they have actually been trending up, right? And I don't think the market's really, noticed it that much, but they've gone up from 0.5% up to just below 1%. And they were treading water there for months. And then the news that the Dems took control of both houses of Congress has seen this spike, right? And that spike has gone through the 1% barrier.
And what's the significance of that, Murray?
Well, now that you've broken through 1% and it is looking like those long bonds are selling off in response to expectations that the US government is going to be spending lots of money, printing lots more money. They're already issuing huge amounts of bonds, right? And the Fed has already said that they will let inflation run hot. And this is just something that came out last year. They're saying that, even if inflation goes beyond 2% for a while, they're happy to let that run. Now we're seeing commodities all picking up across the board. So we're not only seeing the battery metals, we know that they're all moving. We know copper's moving, nickel, zinc, but have you seen soybeans? I mean, soybeans are going through the roof. Have a look at this chart. Here's soybeans on a daily chart, right? That's up from $13 to $20. That's since August again. So we're seeing this huge move there. Let's have a look at wheat. Wheat has been going nowhere for years and is now breaking out to the upside. Sugar has been in the doldrums for so long, but look what's happened since the middle of last year. Sugar's gone from 9 cents up to 15. So,
and hey, Murray, is this because is a lot of these all of these commodities are priced in US dollars, and when the US dollar is effectively getting inflated away, that creates a bullish environment, right?
Well, this is what's happening. So we are seeing. So you're looking at. I mean, we've already know that China is out there trying to get their economy going and happy to shove as much credit into the system as necessary to get it going. They'll build as many buildings as they need to build. They've got this massive demand for iron ore, for commodities. But now we've got the other biggest economy in the world stepping up and saying, we're going to do the same thing. So you've got the two biggest powers in the world now saying, right, we need to get things going, and the Democrats have the will and the desire to spend as much money as needed, print as many bonds as they need, and then the Fed will, issue as many bonds as they need, and the Fed will print as much money as they need to buy those bonds that the market doesn't soak up. So we're sort of, you're already at a game where there's been no inflation, rates are at zero, and now we've got the Dems coming in and saying, right, let's really open the floodgates when debt's already massive, and let's really try to pump it going. So now across the board, I'm seeing, all of these commodities starting to really turn up. And it's not just one or two based on demand and supply. It's all of them across agricultural commodities. You've seen gas prices. I mean, that's a demand supply thing in Asia, but they've just gone through the roof. Iron ore, of course. You're seeing it. It seems to be a very general thing across the board. And to me, in my mind, that is that whiff of inflation. If you've got a lot of printed money out there, the first things are the hard commodities, aren't they? Because you've got too many dollars chasing too few commodities. So,
yeah, I mean, we're coming off the back of 2020, which was such a weird year in the markets anyway. You had the underlying economy, which was pretty much just roasted from COVID. Yet the markets just were going crazy. And I guess one of the observations you just made in your little intro there was that it was really because of one or two tech stocks that was bringing everything up. But now you're saying 2021 seems like it's going to get be just as crazy as 2020. But it's not just going to be one or two things. It's going to be the whole market being lifted, but not necessarily by true supply and demand. It's going to be. Yeah.
And also you've got to watch those long bonds, because in economics you can't really have your cake and eat it too. And the final point of truth in markets is those long bonds in the US. If they react to an inflationary period, and if investors saying, well, I'm not really willing to take 1% when inflation is expected to be 2%, and already the break-even rates of inflation are at multiple year highs and going through 2%, and you've got the 10-year bonds at 1%, at what point do people say, well, I'm not really willing to do that? And then they're going to issue a heap more bonds, so massive supply increase as well. So those long bonds should sell off. But then you've got the Fed in the background saying that they might do yield curve control if those long bonds get out of control. And that's when you've got gold selling off at the moment, because rates are going up, and especially rates are going faster than the expectations for inflation. So real yields, right, are going up, which is bad for gold. So gold's selling off. And this is what I think will happen, is that those long bonds will sell off, and it will get to a point where the long bonds will hurt equities. And so you'll get things like tech stocks and whatever starting to actually sell off because the long bonds are selling off. The Fed will get nervous at some point, especially if it gets a bit disorderly and there's people really start to dump those long bonds. Then they'll step in and do their final sort of holy grail way of saving the market and start yield curve control, which is really saying we're going to price fix. We're going to price fix the most important asset in the world, which is the long bond. And we're going to leave it at, let's say, 1% for the 10-year bonds. The amount of money they'd have to print to keep the long bond of the US at 1%, especially if inflation is taking off, and those bonds should really be selling off a lot. So they're going to be mispriced massively. People will be happy to sell to them, and they're going to print as much as they need to hold that bond at that one rate. That's when gold will do a massive U-turn and just go, and that's when we'll see that breakout through the all-time highs.
And do you expect all that in 2021, or is
who knows?
Who knows? Yeah.
It depends how, like, if the long bond is a very orderly rise, like, because it's just went up 20 basis points, the market's reacting a little bit, gold sold off a bit. So it's, at the moment, it's orderly. So if it sort of sticks around this level, the market will end up taking it in its stride, especially if growth is picking up. But you got to watch it. So if it does actually really, if it goes from 1.1, then, you know, in 3 weeks, it's at 1.3. And then in a month or two, it's at 1.5. The market will be going, oh, what's going on here? So we don't know when the Fed's going to step in, but I'd say it would have to get quite disorderly before the Fed would step in. At the moment, it's not saying that that's happening, but that's the key thing I'm watching in the market at the moment, is those long bonds.
So, Murray, in your update to your paying subscribers of your VIP service last week, you said that there are pretty slim pickings out there in market land right now. Yeah. You say that, but then I mentioned your trades recently. You've been doing extremely well in a very tricky and tough market. Are you excited by 2021? Are you nervous? Or are you just pragmatically looking at what the Fed's doing and the environment in which you're having to trade? Because I guess from a long-term investor's point of view, it's a slightly different thing to how you're going to trade the markets in the shorter term, right?
Yeah, exactly. And I try to have, especially now that I've been trading long enough, the less views you have, the less, if I come into this year saying, I expect this to happen, it's going to cloud my judgment for being reactive to what's actually going on. So as a trader, you have to have your system, you have to have your model, you have to trust your model. I do a lot of work on the fundamental analysis, so I'll find what I like, but then I need my charts to tell me that's okay. And I've got to listen to the charts when they say, no, you're wrong, get out. So I think the more, as a trader, if you're got too much of a view on things, and if you're telling people, I think this will happen or that will happen, I think it can get you into hot water. For me, you've just got to really listen to the market and be willing to let the market do whatever it does. Like last year, I was a bit bearish, and it made me hedge the portfolio. I was still long, but I just hedged the portfolio, but then we got stopped out of the hedge, and thankfully, you know, all those stocks took off. But if you asked me during the crash whether we'd be where we are now, I mean, I would have been wrong. But thankfully, the model took control, and the model got me long all of these stocks, and now we're sitting pretty in a lot of, you know, uranium, nickel, rare earths, lithium, you know, and we got on really early on all of those things, and it really was a function of the model.
One of the things we were talking about late last year, and I think it was an observation that Greg made, was that the Aussie market was at 30-year lows compared to the US market. So that ratio was skewed. It looked like the Aussie market was very, very cheap compared to the US stocks in general. Do you think it's going to be a turning point? I know you're not making predictions.
Well, in the end, that would be a commodity shift, wouldn't it? So, and looking at the way commodities are moving now, and the way the Aussie dollar's moved, from those lows during the crash, it's just been a one-way street. And for me, it's all telltale signs that we are actually entering an inflationary period. Now, none of those numbers are coming through in inflation figures, of course, yet, but seeing across the board commodities taking off, to me, is just a bit of and those commodity currencies starting to move, and the fact that now the Democrats come in and we know they're going to be just getting out there and going on a spending binge, probably on infrastructure, with printed money.
Do you think there's almost echoes of the early 2000s at the start of the super cycle in commodities?
Yeah, well, I mean, it could be the time for that crack up boom. Even, you don't know if they're really going to power it. Maybe they're going to cause that. Maybe the equities will just go vertical, but I think commodities will be a real winner. And especially if the yield curve does steepen, probably good for the banks too. And you'd say, property will be all right for them for the moment, with rates so incredibly low. So maybe, yeah, growth may surprise to the upside, but I guess I'd be wary of those tech stocks that are already at very fully valued, that will be at risk of the yield curve turning up. But the ag resources, mining services, I'm looking at quite closely. Those sort of things, there's a lot of value there. So, it's sort of an interesting dynamic that's happening since that confirmation that the Democrats have taken both houses.
Yeah, right. So what is it? Are there any specific commodities that you're looking at? You mentioned uranium, you mentioned copper, and so are you looking at the companies? I know you obviously you trade the businesses, the companies on the ASX. Are there specific? Are you going directly into the mining stocks, or is it like you say the services side?
For example, with nickel, I'm in Pan Continental, PAN. And they've got a project that's been mothballed that they're bringing back online around the middle of this year. So we bought in at like 8 cents, and it's trading up around 16, 17 now after about 6 months. We've already taken part profit. So I'm really taking on that project risk as well. So I saw upside in them dealing with that, what they needed to do to get the project up and running again. And I was willing to take that on because that looked like an opportunity in itself. And they've also got, a lot of exploration around where they are, around Savannah, that they can do. So I will look at, I like nickel. I think I really like the long-term chart of nickel. So I wanted to get long nickel. And then I went searching through the nickel stocks on the Aussie market. And I liked the PAN chart. It was coming out of it really looked like, they'd mothballed the mine. It'd been absolutely smashed. They'd had to recapitalize, et cetera, et cetera. So you're picking it up for pennies. And yet you're buying into this nickel mine that would be starting production in the middle of this year, when I thought nickel prices should be taking off, and you're getting it really cheaply. So I sort of had a few ticks to the box. It was like, now this one's worth having a stab at.
Do you think I know this has been covered in the mainstream press a little bit, the kind of the sour relations between Australia and China. Do you think that would have a dampening effect on the commodity upswing this year as a result of the policies in the US? Or do you not think that?
Who knows? I mean, who knows how it's going to play out? It feels like China's really just trying to, browbeat us and shake the finger at us, say, we're the boss, not you. So get back in line. So I don't know how long they're going to carry that on for. They've just said they're not taking our coal. There's got to be some endpoint for them. And how Australia responds, I don't know. We don't want to totally shoot ourselves in the foot. I guess we could stop giving them iron ore, which everyone says, but that's probably not a good idea. But really, we're probably earning more than ever with iron ore prices where they are. I think Australia as a whole probably hasn't been kneecapped at all yet by all of this. So it seems to be a bit of positioning and in smaller sort of sectors, which would be hurting people in Australia in those sectors. But I think overall, I think we're not being too harmed by it yet, which is probably annoying the Chinese, I guess. I think it'll sort itself out. I don't think on a world scale of commodity markets, it's going to have a big effect on things.
It sounds like you've got an action-packed few months ahead of you then, Murray.
Yeah, well, look, it's sort of been like I said, it's been slim pickings, because I think a lot of those stocks and the ones that we're long, I'm sort of more in a profit-taking mode right now. But there's going to be a lot going on, and I'm looking at oil, for example. I think oil looks pretty interesting, and a lot of those oil stocks were really beaten up last year, and things like even Woodside, Oil Search, etc. They really got belted so far that now that oil prices are really turning back up, they're starting to look pretty cheap on a long-term perspective. Like, you're picking up some really solid companies. If you're thinking in a 5-10 year time frame, you're getting them at generational lows. So that sort of thing is there's definitely opportunities out there.
Well, I'm going to wrap it up, Murray, because I only wanted this to be a pretty brief chat, but we've it's not, I think you'd probably agree, it's not the market. It's even though there's going to be lots of opportunities ahead in 2021, and the general consensus is that the US is going to open the floodgates with the stimulus. They've started already, they stated their intentions to do that. And that's going to mean inflation at some point, whether that be commodities, but we saw that a huge COVID smash last year, and you can only expect lots of mini booms in the stock market to come in 2021. But that's not something you can just trade without having some kind of strategy in place, because it's a very high risk market, even though asset prices will be probably most likely inflating, right?
Yeah, well, look, I mean, all I do is I've got my model, and I know that I don't know the future. Therefore, I make sure I take profits really quickly on a part of my position, so that we've then got a free option to see what happens. Then we either break even or we make money. I mean, I'm just looking at mean reversion. I've explained it to people in many ways in these articles, and they should read the articles I've written to understand a bit about it. But really, it's understanding how players in the market are positioned, and it's taking advantage of when they get shaken out of their positions, getting into a position so that we can quickly have a mean reversion event, and then I take part profit. And then from then on, it really is just let the market do what it's going to do. I'm not someone saying I know what's coming. I just know how to take advantage of these opportunities and get ourselves into really strong positions very quickly. And then we see what happens. And so we're planting little seeds in the market, basically, little low risk seeds, and just hoping that things will take off, and they have been lately. So it's been going great.
Well, I think your strategy is the perfect thing to kick things off with in 2021. It's actually called the Magnetic Trading Workshop, and we've just opened the doors just in the last couple of days, haven't we?
Yeah.
So it's totally free to sign up to, and you can, for those watching and are interested in trading this crazy market and having a real pro on your side to help you do it in a way that manages your risk, in a way that allows you to cap your risk as much as you can possibly, but allowing you to then open yourself up to any upside that comes and let it run. Like Murray says, planting the seeds and then seeing which ones grow exponentially, hopefully. Yeah. It's called the Magnetic Trading Workshop, right? Yep. And we'll provide a link for you to sign up to now. I think the door's shut for that early next week, I believe. So get in now if you want to.
Yeah. Sign up, and you'll learn a hell of a lot about the way I approach markets. It's definitely worth checking out.
Cool. All right, we'll leave the insider from there. That's lots of insights, Murray. So I think there should be a good takeaway for everyone watching. And we'll do more of these conversations as we go. Yeah. Murray, when are you going to be next featuring in the Insider? I think it's Monday. Right?
Yeah. I'll do a Monday video, week ahead video. Go and check those out, and you'll learn a lot in those week ahead videos as well.
Cool. All right, Murray, have a great weekend. And if you're watching at home, have a great weekend too. Obviously you can catch this at any time, and I'll see you again next week.
Cheers.